Today we're talking about why rolling funds are so hot right now. So hot. So what is a rolling fund and why are they so hot right now? So this is a new type of investment vehicle. So the main things to know about it are that basically investors can contribute on a rolling basis. Hence the name, typically a quarterly subscription that they can put either more money in, the same amount of money in, or stop putting money into this investment fund. These funds are typically publicly marketed. They're continuously open to new investors. It's a very new type of investment product, and it is certainly hot right now if you've checked out investing Twitter or VC Twitter. Hey there, I'm Alex Mitchell. I am the Director of Product at Kin. I'm a 5-time product manager, 2-time founder, and the founder of themodernproductmanager.com. So check out that website. You'll find lots of great content like this, podcast, more blog content, a newsletter. Check it out. You'll definitely find, hopefully, a few things you like. No, I know you will. So let's get rolling. Let's jump back into rolling funds. So couple key differences rolling funds have from the traditional venture fund format. So first one is they continuously raise funding, right? Sounds simple, not so much. In the old school venture world, venture firms would raise big new funds. So think like sometimes hundreds of millions of dollars, even very many hundreds of millions to $1 billion to basically invest over a period of time in startups. And so it would take a big roadshow. It would take a lot of effort for these venture firms, a lot of kind of legal work and diligence, and a lot of stress to raise, this type of money from a lot of very rich people. And so that's one big difference. Another difference is it provides this, funding and investment flexibility on both sides of the equation. So the managers, the ones who are actually running these rolling funds, are able to start investing from day one, really. As soon as those first checks start coming into the fund, they can start writing checks to startups in investments. On the investor side, I already mentioned the flexibility that investors have. They don't have to put all their money in up front into that massive fund and just, hope it does well over the next few years. They can actually watch the investments that fund's making, maybe see some early performance stats and decide to, maintain, increase, or decrease their quarterly subscription. So that's a big difference. And then the last one is, and it's kind of specific to the AngelList rolling fund product, there's a lot more control over fees. Kind of a lot of the legal headaches are managed through this product. So it's really just become a lot simpler than creating your own venture fund. It's actually achievable for a lot more people out there, and we'll talk about who those people are that are founding these rolling funds in a second here. But what about syndicates? So if you've been in the angel space, you may have heard about these things called syndicates, popular on AngelList. The big difference from a syndicate is a syndicate invests in one company at a time. So think about a syndicate as, let's say an investment comes up in a company like Lambda School. A syndicate will get a stake in that investment, an allocation in that round that Lambda School is raising. Let's say they get $100,000 and they basically say, hey, my syndicate, if you're interested in getting a claim or part of this $100,000, you just need to write a check and we're going to put all those checks together and that's going to be our investment into Lambda School. So in my example here, 100 angels write $5,000 checks, becomes a $500,000 investment, a syndicate investment into the target company. So big difference, one company at a time, aggregating angel investing checks so it can be one check through a special purpose vehicle to the company. This lowered the bar a lot to angel investing. So instead of, a person like me having to maybe source these deals, write bigger checks, now a person who leads that syndicate sources the deals through their connections and allows the people in the syndicate to participate in that investment without having to do all of the legwork themselves. So, we talked a little bit about why these funds are different, but why are they getting so popular now? Why is this getting hot right now? So, first, it's just because it's lowered this cost and legal headache so dramatically for a wide new segment of fund managers that I'm calling founder investors. So, these are founders of typically fast growing startups, popular startups, typically founders who have their own community of followers on Twitter or other social platforms. It's now possible for these founders to go beyond angel investing for in their own money, to go beyond syndicates, investing one company at a time and pooling those funds together, to really go up to that next level of starting and running their own fund. So it's gotten so much simpler, so much easier. They're able to do that, and typically in the past they haven't, because there's just been too many barriers. But what's really cool is, as rolling funds have gotten popular over the really only the past couple of months here, you can see that these founder investors are able to raise $1 million rolling funds or multi-million dollar rolling funds in many cases in a matter of weeks. And this really scales their impact dramatically. So instead of only doing maybe $10,000, $25,000 checks and do a small handful of startups, they're able to now control millions of dollars of capital and allocate that to startups. So they might be 5xing or 10xing their investing impact into these startups, and they're able to even make more bets because of it. So it's really getting popular for all of these reasons. So who has one of these funds? So, a lot of names you'd recognize here, or especially companies' names you'd recognize, even if you don't know the CEOs. Sahil is one of the most prolific, as is Ahmad, of prolific supporters of rolling funds, for many of the reasons I've highlighted. You can just Google their name and rolling fund. You'll probably see some of their tweets. You'll probably also see their angel list pages for their funds. Again, publicly marketable. You can learn about their investment thesis. You can learn about their past investments. So check out some of these names, and there are many, many more out there. Again, this is kind of catching fire for many of those reasons, and a lot of the most prolific founder investors are getting on board. So, should you invest in a rolling fund? Well, Sahil would say, yes, everyone should angel invest, as you can see from this tweet up here in the top right. And, I would tend to agree with a few caveats. So, first, what I call kind of pure old school angel investing. So, writing checks individually to individual companies, in my example, Lambda School, or joining a syndicate that invests in Lambda School. This should only be done with money that you are completely willing to lose. It's going to be locked up for a long period of time. You're not going to have much information on the performance of the investment other than what that company shares publicly, or in some cases shares with the syndicate. And so, when you talk to most financial professionals, they would recommend a maximum of 5 to 10%, probably more on the 5% of side, into this type of investing. And I'm not saying angel investing, but I'm saying investing in money or in places that you could lose and still be okay. So it's not a big allocation of money. However, as you start to get into rolling funds, that may be different. You may go on the higher end here. You may even go a little bit higher than that 10%. And there's a couple reasons. So I have a hypothesis that angel investing, and specifically this diversified angel investing in these rolling funds that have some interesting traits, is actually going to displace small cap publicly traded company investing. I'll tell you why in a second here with a few examples. But if you aren't familiar, so small caps, these are the smallest public companies out there. You probably actually don't know the names of too many small cap companies today, because there are many startups kind of skipping over this stage of the market completely. It used to be, if you went back 10, 15, 20 years, small cap stocks would be more volatile, but they would command higher long-term returns in exchange for that risk and volatility. So we're going to jump to a few examples in a second here, but one disclaimer before we jump any further: none of this is intended to be investment advice. Please talk with a financial advisor if you're considering any investment strategies, including rolling funds. So this theory about rolling funds replacing startup or replacing small cap public investment, if you look back at the first dot-com bubble in 2099, if you just look at small cap companies in the past, even before that bubble, you can find many examples of household names that went public at very small valuations relatively. So, an Amazon, for example, went public at a valuation of $300 million. Dell, $85 million. Apple, almost 2 billion, but when that company's worth over a trillion today, it's quite a lot of appreciation over that time period. So if you believed in these stocks, you got to invest in them as they went public as small cap stocks, and you got to benefit from a lot of that appreciation. Today, however, though, as a lot of startups are completely skipping over this small cap stage on the market, you're missing as a public only investor in a lot of that appreciation that these companies can have. So you're getting bypassed completely, to the point where, in the most extreme example, you have a company like Uber going public at an $82 billion valuation, if I remember correctly, or Snowflake going public and reaching 50 billion, 60 billion in valuation before you could even buy a share. And so a rolling fund, again, imagine you're investing in Sahil's rolling fund. Let's say he does 20 startup investments each year. You're investing, let's say, $20,000, $40,000 each quarter in that rolling fund. You're getting exposure to investments and companies that you otherwise would have completely missed this kind of small cap growth stage if you had waited for them to go public. So that's part of what's behind my hypothesis that rolling funds may be the new small cap investment. So I hope you enjoyed this content. Again, if you did, please check out more at themodernproductmanager.com. Also, please subscribe to my channel on YouTube. Check out some of the other content and like this video. It goes a long way. A lot of great free content out there from the Modern Product Manager. Also, some bonus resources. If you're interested in becoming a product manager, you can also find that at themodernproductmanager.com. Thank you.